Matthew, always good to have a chat to you. This is a conundrum right now, isn't it? Because on one hand, you've got, that risk of the global economy sort of getting weaker. So that means interest rates don't touch them. On the other hand, you've got inflation rising. That means actually we better start to raise interest rates. So there's an issue here for people think about buying a house, in business, whatever it is. You've got to make a decision right now.
That's right. And it's a conundrum for the RBA as well. Most of the time they need to look through these sorts of events and have a view for the medium term. We know Australia, yes, petrol price is a big factor for our CPI. It's an inflation burst, but it'll presumably unwind over the medium term. And other aspects of this crisis are actually quite positive for Australia. If you think about commodity prices, we're a net energy exporter. So we get a wave of a windfall gain for our energy exports. It won't flow through to many households, but it does flow through to the wider economy to some extent. So it's really tricky territory for the RBA. I think alongside that, it's the other things that make this really tricky. The fact that we're seeing a more generalised inflation globally around goods associated with supply chain disruptions, not just energy, and that we've got this move in the labour market locally, which is about to hit extremely tight conditions that suggest that medium-term view on inflation is not going to be so benign, and they will need to move at some stage. Question, of course, is exactly when.
And so there are even figures out this week showing that even though Australia's borders have opened, that we haven't had the mass inpouring of labour that we might have anticipated. So in other words, at this stage, lots of people, like Australians, are kind of prepared to stay at home. That doesn't help our labour market. That really doesn't help to take pressure off the wages.
Yeah, certainly right here, right now. We are starting to see some early signs that that's starting to shift. Our Westpac card tracker data looks at credit and debit card expenditure, and we have seen a significant quickening in travel-related spend. I think people are locking down the flights for those trips, whether they're domestic or international, a bit hard to tell at this stage. But certainly the influx of workers to refresh the labour market domestically, that hasn't happened yet. It may take time. It may be more restrained than expected. People are coming out of a pandemic. They're a little bit concerned about being left high and dry if we were to see a new variant and a new issue emerge. So I think, there are some huge questions facing the Australian economy, quite aside from petrol, global supply chain shocks, domestic labour market conditions, international borders. There's a lot of moving parts here. And I think, as you said earlier on, the RBA has taken a deliberately reactive approach to this policy move. They're going to wait until everything's flashing red before they move off the 0.1% cash rate. And that almost bakes in a mistake. If they wait too long, they could be playing catch up, and it mightn't be about whether they move this year, by May, June, July, August. It's how far they may need to move in total if they get inflation.
And the danger of that is if they raise it too quickly, they might just frighten the horses in the property markets and other areas. So again, this is the balancing act, because what you don't want to do is suddenly frighten your property investors, to frighten your property owners, and have them suddenly say, right, we're going to not buy, or we've really got big troubles here, because that wouldn't be good for the housing markets. That would not be good for Australia's economy.
Absolutely not. If you ended up that you're jumping at shadows, that the oil price spike reverses by year end and there's nothing left inflation-wise, if it actually maybe nobbles demand domestically because consumers have to meet these higher petrol costs, and if you've delivered too much of a blow for the household sector, for the housing market, then that's an issue. I think it's the sentiment aspect, the sentiment dimension becomes really important. We think the housing market will be pretty sensitive to interest rate moves. In the past, it's taken...
Well, people have got such big mortgages these days, let's be honest. They've been able to borrow to their capacity. $500,000, $1 million is pretty standard these days in the major capital cities.
So the question around that is they've also accumulated very large reserves over the pandemic period. $250 billion as a war chest for the household sector to play with going forward. And to some extent, that could be drawn down as a buffer. About $100 billion of that is sitting in mortgage offset accounts. Really, though, the housing market's about that marginal buyer. What's that new buyer able to borrow? What's the burden of meeting those mortgage repayments? So we think it will be, in previous tightening cycles, we've got to go back a long time, right? We've got to go back a couple of decades to see the last tightening cycle. It took about 100 basis points before interest rates really bit in the housing market. You started to see things slow. 100 basis point was the tipping point where we started to move into correction phase. We think it'll be 40 or 50 this time around. But there's still, again, there's a few open questions around that.
Well, as I always say, Matthew, it's always the last interest rate rise. That's always the one that does the biggest damage of all. Thank you so much for your time.